Hi, I wanted to give you an explanation for essential question number 1 that was given on April 30th, 2012. So what we're looking at here is a free-range earthworm farm that produces and sells organic fertilizer and earthworms. Yeah, you'll notice that the examples start getting a little strange after a while. But you'll find that the transactions are, pretty similar to the ones that you've seen before. The first one is that, which will be done in red, you take out a loan in order to have extra cash on hand, interest-free. That ends up being important later. So remember, you're taking out a loan, you know that you're doing an increase in liability, so that's there. And that's bounced off by an increase in assets because you got the cash that's coming in. And let's go ahead and make sure everyone remembers that the changes in assets are supposed to equal to the changes, equal to the sum of the changes in liabilities and the changes in owner equity. So sometimes we'll have it all balance out on the asset side, but other times we'll need to make changes on both sides of that equal sign. Now, because we've got this loan going through, remember that stuff that happens over here in the balance sheet echoes over into the cash flow statement too. Generally speaking, if you got changes in assets because you're buying and selling them, it shows up in investments. If you got changes in liabilities or owner equity, it shows up in finance. So what we're going to do here is say that, well, look, what we've had here is an increase in cash because that's what you're watching, and that'll be an increase in cash from finance, and that's the connection that we have there. Next question should be in orange. You fired 2 earthworm farmers from payroll because they weren't doing anything productive anyway. Yay! Let's go ahead and get rid of some expenses because that's what those people are. And we'll make it so no revenue decreases or anything like that because they weren't doing anything anyway. Reductions in expenses ends up having a reduction in net income, but please note again that there's a connection between the income statement and the cash flow statement, and that connection is through net income because net income is a component of cash from operations. So heading back again, this decrease in, oh sorry, I got the sign on this one wrong, so my apologies. Decrease in expenses should result in an increase in net income, just to go ahead and make that one clear. So I'll do my best to erase it, but that's not working really well. So it's an increase in net income and an increase in cash from operations. There we go. That works out a little bit better. Next item is going to be in yellow. And so what you're going to do is issue 5,500 shares of new stock. Easy. That means you sell it. So what you're going to have is an increase in owner equity and an increase in assets at the same time. So you end up with this cash that's coming in, and it's balanced off by changes in owner equity. Now remember, there's the echo that happens on the cash flow statement. Owner equity changes are typically taken care of in the cash flow statement, so you'll have an increase in cash from finance. So let's go ahead and switch to a new color, green, in order to have a payment on your loan that's interest-free. The interest-free part is there to make it easy for you. So what's going on here is you have a decrease in assets because you got some cash going out, you're making a payment. You're also having a decrease in your liabilities, and those guys balance each other out. And then finally, because this is something which is finance related, you're going to see a decrease in cash from finance. A little bit later on in the class, when we are working on income cash flow statements, we are going to do a lot of things relating to loans because we have to split up loans into the interest part, which shows up on the income statement, and the principal payment part, which ends up on the cash flow statement, because one's an expense, the other one isn't. And that should complete question number 4. So let's switch to blue. Purchase a new hybrid electric tractor for the company with a credit card. So this is one of those compound transactions again where you suddenly got yourself a tractor. That's a fixed asset. At the same time you increase your liabilities. So that balances out right there. And while it doesn't look like there was any kind of net cash flow here, if you look at it, there's 2 chunks to this transaction. One is an asset purchase. So that would be something would normally have a decrease in cash from investment. And the other part, there's a loan, which would result in an increase in cash from finance. And that's what's going on. You've got a decrease in cash because you're buying the tractor. And you have this offsetting increase in cash because you're taking out a loan. The net is 0, but they're still there. It just doesn't do anything in net. All right, so let's go ahead and get the light blue out here. The Oregonian features your company in an editorial, environmentally conscious business. Sales of fertilizers and earthworms increase as a result. Great. Increase in revenue, increases in expenses, and you're not quite sure what happens to net income. Odds are on it's going to be positive, but we're going to go with don't know for sure, And so you can have don't know for sure in cash from operations. Because remember, anytime net income changes, cash from operations changes. So let's go to the next color, which is purplish. For question number 7, decide to expand your operation so you rent out the empty lot next door to your current location, month to month, no lease. The month to month with no lease agreement is just because long-term leases actually have some weird asset and liability sides to them, and we're trying to avoid in our simple problems. So what we've got going on here is this renting out increases your expenses. Increases in expenses, go ahead and decrease your net income, and that actually will decrease your cash from operations. That's the chain there. You may end up doing something with increases in revenue, but we'll sort that out when we grade. And then the last item is, and will be in black, competitive pressure forces you to lower your fertilizer prices to keep sales volume constant. So what we're getting at is that basically prices on everything are going to go down. So what you're going to see is there's this decrease in revenue, and the reason why this sales volume is being kept constant, so that you know that there's no change in expenses, and so what you're going to have is a decrease in net income because your revenue went down, and a decrease in cash from operations. So that should go ahead and handle essential question number 1 that was given on April 30th, 2012.